Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Happy to be back with you again today. I'm your host, Dr. Alan. I know you'll enjoy today's show, and I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. To leave a review and a rating, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either site, search for Real Estate Investing Abundance. Once you find us, leave both a review and a rating. Subscriptions are also vital to the show's success, so please be sure to subscribe on your favorite podcast app. It's free to subscribe, and you can unsubscribe at any time. After graduating from Illinois State University with a degree in marketing, sales, and organizational leadership, our guest went on to manage a successful nightlife business in Chicago. Leveraging his contacts in that industry, he started investing in small multifamily projects with foreign investor capital. This led to him co-founding a multifamily acquisition firm in 2013 at the ripe old age of 26. Enlightened investors, let's get inspired with our guest, Garrett Lynch, and discover how millions are made in the Valley. Garrett, jump right in and share the story of an experience from your formative years that helped you to be the person you are today.
So I think a very notable one is just I had lost. I had to make a decision. At a certain point, I was dabbling in the industry and I was doing like some wholesaling, and I was like, how do I up my game? And what do I need to do to get there? And so what I really needed was knowledge. And so we had an opportunity. My friend at the time had an opportunity to go work for a guy that had about 1,000 apartments underneath him to help him buy more. And he brought me along with him, and I was able to go and work for this guy, even though I didn't really want to work a job. I did it just for the knowledge, so that over the next 8 months, I learned the inside game as to how he was doing things. That was super transformative because it just gave us an insight as to what this whole business was about and how it worked. And we learned a lot of great tips and tricks that allowed us to, when the time was right, to jump ship and go and take all of our contacts that we had built over the years doing wholesaling and turn it into a profitable syndication business. I think at that time, that was, had we not gone and grasped that knowledge by working for this person, we wouldn't have known what to do. We always had the intention, and so we had to eat our pride while we were there of starting a business. And that was tough, of course, but without that experience, we wouldn't have been able to start that business up in 2013.
Sure. You started out with D-class properties and Section 8. So first of all, explain to us what a D-class property is and what is Section 8, and talk to us about those initial experiences of working with D-class properties and Section 8 properties. And I know you had to have learned a whole lot in conjunction with that. So just fill us in on that whole experience there.
Yeah, D-class. So it really, the classes start obviously at A and go down to D. And if you think about your A-class property is going to be your lowest cash flowing property with your highest equity potential exit. And then it goes down. So B is going to be a little bit more cash flow and still some decent amount of equity. And then C is much more cash flow, less equity, tougher management. And then D-class is the toughest management, no equity, a lot of cash flow, often paired with Section 8 tenants. And Section 8 is just tenants that are getting paid by the government to live for free, or for the most, or they have to pay a small portion, and they have to meet certain income, like low income requirements to be able to qualify for Section 8. And then they get what's called a voucher in a lot of instances. And then they move into an apartment that they get to choose. And then the rent comes directly from CHA or whatever the housing authority is. At the time it was CHA, so Chicago Housing Authority. And so that people think that comes on autopilot. And it can, except there's a ton of management headaches that go along with it. And you have to pass inspections in order to get that money. And so if a tenant decides that they don't want to live there anymore, they'll just break something and then you stop getting paid. So we run into issues with that. So D class is like the low hanging fruit, because on paper it looks really nice and it looks like it produces these great returns. And then you get into it and you realize that there's just a ton of headaches that come with owning the property. And the juice is often not worth the squeeze. That said, everybody's got to start somewhere. I don't recommend starting with D class. I decided to start with it because we knew the south side of Chicago. We were like wholesaling down there. So it was an easy place for us to start and we were familiar with the market. But when we got into we purchased everything. When we got into actually selling it, there were a lot of challenges around getting financing, keeping it full, these things are renovated. You'd renovate it, and then the tenants would go and mess everything up right after you renovated it, and then you got to do it again. And so a lot of deferred maintenance issues. Overall, not that profitable of a venture because there's so many things you can't predict. And I think that's what the whole D class game is. Very high risk, in my opinion, and definitely not worth the headaches that you get into it for. So would I be where I am today without that? Absolutely not. So was it worth it? Looking back, yeah, it was worth it. Would I have started there again? Probably not. But I had at one point over 600 D-class units. And the stories will live forever from that though. So that's a cool thing to have those memories.
I want you to share a couple of those stories here, but before we get into those stories, you used a couple of terms. If you could give us some clarity on them. You talked about A-class properties have the most equity, the lowest cash flow. D-class properties have the least equity, but the highest cash flow. Could you explain to us, not in the nitty-gritty details, but aerial view of what you're talking about when you're talking about equity and cash flow?
Yeah, let's make it simple. The two flat, you're paying in an A-class building. It's brand new. It was just built. Let's say it's 2019 build or something like that, or 2020 build. And the cost per unit is $200,000 per unit. And you're getting like a $2,000 rent per unit. Whatever. Okay. So the cap rate on that deal is going to be really low. And the cash flow is also going to be very low because 2,000, you're paying 400,000 for the building and you're getting 2,000 for each unit. It's just not, it's just a lower return. All right. But you're in a safer area. There's trade-offs. You're in a safer area. That building can appreciate on a good block. If things around that block start to blow up, like you get a Whole Foods on the corner, you get a Target, whatever. Now that thing can appreciate a lot higher. And it can increase in value probably much faster if you do it right. If you're buying on the right corner and you buy at the right price. So you're playing the equity game in that sense. Not necessarily as predictable. You just have to be good at your location where you're buying and then the pricing that you're getting. If you overpay, you're in a bad position. So then you go to the same let's say it's a similar two flat, but it's built, I don't know, let's say in the 70s and it's in a bad location, a bad neighborhood. Okay, now let's say that same 2-unit duplex, each unit costs $50,000 a unit. Okay, and the rents are $1,500. Let's say. Okay, well you're getting similar rents, but you're paying way less for the property. It seems like this is a home run. Let's do it. Except now you got a lot of problems because it's in a bad neighborhood. Crime. You got people not paying rent. You got all kinds of things happening that are out of your control. They're beating up your property. Now you have to turn the units multiple times a year because of how bad things are happening, whatever. So that property now that you thought was going to be a big cash cow because you paid so little for it and you're getting such high rents now becomes way more expensive than you thought. And not only that, no one else wants to buy it because they don't want to be in that neighborhood. So now you don't get any equity on when you go to sell it, or very little, because there's not a high demand to buy in that area. You're buying it simply for the rents that come in. So that's the trade-off. That's the difference between buying A-class versus D-class. And then there's the in-between. There's B and C, which is where a lot of people play because you can get a combination of both, which is where we play right now. But that's just the high-level contrast between the two properties.
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
Good example, Garrett. Thank you for that clarification. Share with us one of those stories from that D-class properties.
So I'm going to show you. Why not? Let's show you one. So there was a deal that we did. So we scaled up from, let's say, a small We had like 300 unit portfolio D class stuff. And then we bought like a 50 unit, then a 70 unit, then a 120 unit. We're like, okay, cool. And then we found this like 380 unit in Memphis that was very similar to the 120 unit price point that we just bought. We're like, wow, we should go pick this thing up. It was like 20, I think we picked it up for like 22 a unit or something like that. So it was very cheap. And we went into town and we looked at it and we're like, it was 80s built. It looked awesome. We could totally do this. This is great. Wow. We're going to buy a 380. It was like a city, like a little city. We were so pumped. So we're like, we can raise the money for this. We can get the loan. Let's do it. So we go at this deal. And the day that we were supposed to close the deal, the seller, we just can't find him. He's gone. And we're like, what happened? Like, where'd he go? And so then we get a call from the manager of the property and they said, hey, yeah, let's call him Bob. Bob is gone. We had some people visit the office last night looking to kill him. What? Yeah, they're out hunting for him right now. They're trying, these gang members. So apparently he upset some gang members on the site and they were looking for him. They came to the office with guns trying to kill the seller. So now the seller is hiding in like Montana. And so that's why he wasn't at closing, because he was hiding in Montana. And so we're like, oh, okay. So we're supposed to buy this thing like that day. So then he finally surfaces a couple of days later and closing gets pushed, of course. And he's, yeah, sorry, I got people after me right now. It's a little hairy. He's like, you'll be fine. It's okay. But just know that there's some characters on site. I'm like, oh boy. So we ended up closing the deal. And we get in there and sure enough, there's gang shootings on this site. Like one side has this gang and then the other side is this gang. And then they're like on a warm summer's night, they'll go out and duel it out and bullets are flying everywhere. And we were like, wow, that's crazy. And so I went to the site and I didn't know what to do. I was like, I've never dealt with this before. What do we do? And so I called the seller up and I'm like, hey, what do we do here? He's like, there's one method that I did that worked. If you want to do it, it's kind of crazy, but your risk of continuing these shootings is much worse than you just doing it. And I was like, okay. And he's, you can't call the cops because they're limited on police right now. But you just hired the security companies, like they got a lot of firepower. And so what happened in Memphis is that they're supposed to have 5,000 cops at the time we bought this deal. They only had 1,500. This is after the crash. It was like one of the first, it was not really 2013, but still they haven't recovered in Memphis. What happened was all these police that didn't have jobs down there, you would call 911 and it would go to voicemail. That's how crazy it was. A lot of them were doing these private security, like almost like militia style security companies. And we had just hired one. And these guys had like full vests and like shotguns. And they were like my like mini militia on site. And so he's like, you're going to do what's called a 30-minute eviction. He's like, what you're going to do is when you find out who did the shooting, he's figure out, you just got to ask around. They'll surface eventually. He's like, that next morning, he's like at 5 a.m, you send 10 guys in, kick the door in, and then zip tie everyone inside, guns drawn, everything. And then take the tenant, throw her on the street, say she's got 24 hours, come get all her stuff, board up the windows and doors, arrest anyone inside that has a warrant. And it'll spread like wildfire throughout the property that you're doing that. And people will stop messing around. It's like, whoa. So another shooting happened. I was like, all right, let's do it. So we did it. So we sent guys in, had 10 guys with shotguns, like bust the door down, gang members inside, zip tied them, had the cops ID, boarded up the windows, doors, did exactly what he said. And there's 2 more shootings after that. We did it 2 more times. And then I got crafty and creative along the way. And I put up big blue light cameras throughout the whole property. I put a perimeter fence around the entire thing. I put in a 10 p.m. curfew on site, which we figured out we could do. And I had these guys patrolling all the time. And pretty soon all the crime cleaned up. And we were able to take the property from 75% occupied up to 95 after doing those steps. But I just got thrown into a crazy crime-ridden D-class property in Memphis. It was like a city. I had to figure out how to make it work and clean it up. And we ended up doing it. And exiting at a profit. So just crazy story.
No kidding. It ended successfully, but it sounds a lot more like a horror story.
There were 30 people moving in and 30 out every month in that property. And then we had 50 units that had bed bugs that we couldn't pay $1,200 a unit. Couldn't afford to pay that to get rid of the bed bugs. And then people would throw their bed bug mattress out by the dumpster and someone else would come pick it up thinking it's a free mattress. And then they get bed bugs. So it was just, there was endless amounts of issues on this property. That's just an example how D-class is really crazy and very high risk.
What a learning experience. My gosh, you couldn't get that in 100 years of university education. Wow, what an experience. Anyway, you started your firm, scaled that to 3,400 units within about a 10 months period of time. Talk to us about that experience. How'd you do that?
So there was two parts. There was us just buying. Like we figured out that found this guy in Florida that had basically he had a lot of people that wanted to put money, high net worth investors into deals and apartment deals. And we partnered with this guy and we basically had unlimited equity for deals up to like $10 million. So if he liked the deal, we cut him in the deal. He had his investors come in and we got a check. We closed the deal. So when we figured out we had that, and they're favorable splits too. It was 65-35 splits and then up to 50-50 if we did a full cash out refi. And so we were like, let's just buy as much as we can now. And we weren't that sophisticated in like underwriting or anything, not anything like we're doing now. We just knew that if we bought a deal in the 20 to 35,000 a door range, we'd probably profit from it, which doesn't work now at all. But at the time it kind of did. And so we scaled that. We just started buying wherever we found deals like that. So we bought in Oklahoma. We bought like Tulsa, Oklahoma City, Columbus, Dallas, Houston, like all over pretty much. We just bought wherever we thought, and we self-managed everything because we got burned by a couple property management companies along the way. So we used all of our acquisition fees to basically fund an internal management company where we just created everything from scratch. And I didn't know what I was doing. I didn't know what an HR department was. And then I had to build it because I'd never worked a job. I didn't have HR. So I was like, oh, what's HR? Oh, we need that. Oh, let's build it. So I was like in charge of hiring pretty much. I hired 250 people for our management company. We did this. And we had about 130 employees between all the sites and up top and everything at one point, and just kept scaling and scaling. And it was crazy. The whole thing was we did it in 3.5 years, and we bought, I think, $250 million worth of property in that amount of time, and then self-managed all of it. Definitely a wild experience.
So this was through one contact with one investor who had lots of money he wanted to invest. How did you come in contact with this investor?
So my business partner at the time, I think he sat next to him on a plane or something, totally random. And then they figured out they had mutual friends, and then they did one deal, and then that led to more. And then it was pretty much an endless supply of equity at the time, which was pretty nuts.
You said that basing on your criteria, which was basically a pricing criteria, you said it worked then, but it won't work now. Why did it work then? It won't work now.
So then we were riding, we didn't know it at the time, but we were like towards the beginning of the upcycle, and maybe you can't buy deals for those kind of prices anymore at all. And so now with where we're at in the market cycle, it's just a different game. You have to be strategic about your plan. We were just throwing anything at the wall, and it was sticking because we were riding that natural market appreciation. Now, if you try to go do anything like that, you're going to get burned because the only deals you're finding at those kind of prices are in the deep hood or in real bad markets or whatever. And so the game that you play now that the market's changed is more like a legitimate value add play, not just sitting on deals. A lot of deals are market rate. You have to go in and find the deals that have a lot of classic apartments. So I'm hunting for deals that have classic exteriors, classic interiors, maybe 80s vintage, 70s to 90s vintage deals where we can go in and add significant value to the interiors and exteriors. And that's a different game than what we were doing before. We just paid $166,000 a door for a deal in Atlanta that we really liked, that we thought had a lot more upside. So if I'm hunting for 35,000 a unit right now, I don't even know what I would buy. I don't even know where that exists. Some way off tertiary market versus paying up for the location, finding an asset that has a lot of value to be added to it in renovations, and then going that route. And so we have more of a construction heavy focus on what we're doing, more of a location based focus, and just quality overall. We're delivering a much more quality product to the market. And this is a new partnership that I have. I exited that one in 2016. And then I'm partners with Michael Blanc and Drew Niffen right now. So totally different partnership and new strategy.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. I'm sure it's a very different strategy than what you were using back in the early days of your career. But you were doing the sourcing yourself, and many of your properties were off-market sources. Is that still the case today, or are you using brokers more so today since you're in a very different class?
Yes, I think there's different types of off-market. I think there's off-market where there's off-market deals that are being shopped around, which are almost like being on-market deals in a way because everyone's seen them. They're just like secret behind the scenes. And then there's off-market deals that you get that are, you're one of 10 people that actually sees it, or you're one of 5 people, or the broker brought it just to you. There's that kind, which is definitely probably more lucrative. You just got to be careful that the numbers you're putting in are not. I look at every deal, whether it's market rate or off market, as they're trying to get the highest price point. So you got to be careful on that. And then there's the direct to seller deals. We're just going directly to the seller. We just landed one recently. And those are awesome because you can get, maybe the seller isn't into what's going on in the market or something like that. You can get a real price advantage on stuff like that. So most of my deals are definitely off market, but that said, some of my most successful deals have been in a competitive bidding situation where there was a bit of hair on the deal, let's say. And even if you paid market rate, it didn't matter, or even overpaid. It didn't matter that much because there was so much upside left over. So we just did a deal at the end of 2019 in Huntsville. 276 unit deal. We bought it for $18 million and put about $2 million into it. We're getting unsolicited offers for $34 million right now. And that was a competitive bidding deal where we had to win it. So I favor the off market deal because I don't like the whole song and dance around the whole process of bidding and like an auction style, which is what a lot of these brokers are doing now. And I get it. It helps the sellers get top of market for their asset, but it's frustrating and it drives prices way up, and it also can mess with you if you don't know if you're going to win. You don't know who's on the other side of it, what people or what kind of crazy antics they're doing to win these deals. So I definitely prefer the off-market situation where I know if I put an offer in, there's a good chance it's going to go under contract in a week or two.
And how are you finding these off-market properties?
Yeah, so a lot of it's just being real scrappy and building the relationships out. So like I do like in-person relationships I think brokers are a great place to start, but actually getting face-to-face with them. So you actually meet them in person, touring their property, even if you're not like super interested in it, but you get to be in front of them, flying the market, spend time with as many brokers you can, have breakfast with them, whatever. I think that goes a long way. And then if you want to do like other stuff, like call sellers and introduce yourself, you own in the market. I like to call other owners and be like, hey, I'm an owner in town. I just want to introduce myself. I own this deal down the street. If you ever have anything you want to sell and you don't want to go through the whole broker game, just call me. I've gotten deals that way too.
I think you had your first company for about 3 years or so, and then you sold out completely and started traveling. Traveled to 17 or so different countries, 33 cities. Tell us about that experience of deciding that this is enough with this business and I'm going to take some time off. Tell us about that whole experience.
Yeah, no, I had the business was going well, but I think there was some differences in my opinion with my partner on which direction the business should go. And so it ended up not working out. It was a situation that I had to get out of. And so we ended up parting ways, and I went through a business divorce essentially. And it was very tough, very hard thing to do. This is a very close friend of mine at the time, mentor, somebody that I looked up to a lot. And then all of a sudden we just weren't talking anymore and our lawyers were talking. So that was a big shock for me, a big thing. So I think at the end of all of it, we came to an arrangement. I ended up getting bought out of the company. And so I had a bunch of cash that just got dumped on me. And I was like, I'm just going to go travel for a while and I'm going to see the world. I got nothing. I went from having 200 emails a day in my inbox to nothing overnight, pretty much. And I was like, you know what, when we get out of this, I'm just going to go. Booked a one-way flight to Thailand and then ended up in North Korea, ended up like Vietnam, ended up all over. And it was just a really cool thing that I was able to do at that time in my life. I recognized that I didn't have a lot of responsibility. I had a lot of money at the time compared to what I had before. So had resources. And I was like, if this is a once in a lifetime thing, let's go for it. And at the end of it, the funny thing is I ended up being pretty unhappy at the end of the trip because I wasn't producing anything to the world. I thought the end game for me was to end up on a beach and just be retired and have tons of money and that's it. And I tried that. I simulated that when I was in Australia. I went to this beach called Bondi Beach and I just chilled out for 2 weeks on this beach. And I was like, I'm just going to do nothing and see how it feels. And it felt horrible. It was just like, what am I doing? All these other people are being active. They have routines, they're whatever. I'm just like drinking every night and going to restaurants and just doing nothing. And if it really wasn't fulfilling at all. And in that moment, I knew, I was like, wow, I got to get back to America and figure my life out. And so I went on this trip looking for answers. And the answer I found was get back to work.
Enlightened investors will be right back after this important announcement. I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. So to leave a review, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either platform, search for Real Estate Investing Abundance. Once found, please leave a review and a rating. Subscriptions are also vital to our show's success, so please be sure to subscribe on your favorite podcast app. It is free to subscribe, and you can unsubscribe at any time. You came back. Tell us about coming back and how that was working for you and how you got connected with Michael Blank's organization.
Yeah, so I found Michael online similarly to how most people probably find him online through his content, and he was easily searchable. And I was like, oh, this is cool. I reached out to the organization because I heard that they partner with you or something like that. And so I got on a call with my now partner, Drew, and he's, hey, do you want coaching? You could do this coaching and spend some money and coach with us. And I was like, I don't know. I actually think I have a lot of knowledge and experience. I just need to like partners or something. I was like, I didn't even want partners at the time because of all the stuff I just went through, but I was like, I just need it at this point. And so I was like, listen, if I brought you guys a deal, would you do it with me? Because I can find deals. I'm pretty good at it. And they're like, yeah, we can do that. Sure. So I came with one deal. It was a weird deal in West Virginia or something. And I almost did it. And then it didn't work out. And then I came to them with a 545 unit deal in El Paso. And I was like, hey, this is a good deal. We should do it. I was like, I'll work the deal. You guys bring the money and we'll get it done. Do you want to do it? And they said, yeah, let's do it. So we worked this deal like a job. Like I worked it for a year and it ended up, long story short, like falling apart completely, like horribly falling apart. And we all lost our earnest money and it was this whole thing. But we didn't want to kill each other at the end of it. So we're like, you know what? This is we worked together for a year on this project. Let's try to do some more. I think there's more here. And so then we closed 218 unit in Little Rock, Arkansas. We closed 276 units shortly after that, which is my biggest deal ever. That was the $18 million deal. And then we closed 2 more back-to-back last year. We had COVID hit, obviously, in the beginning of the year, so we didn't do any deals then. And then we had 2 deals in Atlanta. We closed in 90 days, 45 days each one. We raised $20 million between the 2 deals. And that was our last one was our biggest deal, my biggest deal in my life. And then we're closing another 80 unit now. So we're building a nice little portfolio together. And I'm just grateful that I am going into this partnership with a much different set of eyes on how to pay attention to the partnership. That has to stay healthy. That's like a marriage. And if you're not aligned on why you're doing things, if that's not aligned, then you're not going to see eye to eye on stuff and it's just not going to kind of work out. But I think we're all very much on the same page and it's been really fruitful so far. I don't look at things like it's going to last forever. I hope that it will, but it's just having that awareness that average partnership lifespan is 3 to 7 years, right? But I think that's the healthiest way to look at it because it's not like I'm not going into it as naive as I was in my last one. I just thought, oh, this is it forever because I know it can change in a heartbeat, but we're constantly putting in work to make sure that the partnership is really thriving at all. And if there's any issues that is brought up right away and we understand each other, and it's been super valuable. I can't say enough good things about those guys. I think they just have the utmost highest level of character, very intelligent people. And it's truly a gift to be able to work with them. After my last situation, this has been fantastic. It's awesome. to where we're at now from where it was before.
Garrett, a lot of insights and wisdom you've shared. Thank you so much for sharing those stories you shared with us, your successes and your setbacks. Before we go, can you tell our viewers and listeners how they can get in touch with you?
Sure. Yeah, you can email me at Garrett, Garrett, at Nighthawk. It's NIGHTHAWK equity.com. So Garrett at nighthawkequity.com. Or you can go to our website at nighthawkequity.com and join our investor club if you like. There's some great insight there. You can obviously check out my partner, Michael, online as well, Michael Blanc. You can just Blank. You can look him up too. So however, but yeah, I love when people reach out if they have questions or anything. I'm happy to, very available. And I like giving back to people that are looking for answers. So happy to reach out anytime and I'll respond.
Garrett, it has certainly been a pleasure. Thanks for being on the show today.
Thanks so much, Alan.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.